On January 11th, 2026, at 8:01 a.m., the White House announced a 100% tariff on all imports from Canada, without prior notice, without a transition period. The impact was instantaneous. In less than 4 hours, the Dow Jones Index fell by 1,200 points, and Wall Street executives went into emergency meetings. And no, this is not theory. It's not speculation. It's already happening. While most people still don't understand what this measure represents, the largest trade deal in North America, valued at $2.4 trillion, has technically collapsed. This changes everything. It changes international trade. It changes the United States economy. It changes the life of anyone who depends on low prices, stable employment, or predictable investments, including you. Most people are distracted, thinking this is just another political move. But those who understand what's behind this decision are already repositioning themselves quietly. By the end of this video, you will understand exactly why has Canada become a target, what is at stake in this billion-dollar deal, and what stage are we at in this trade war now. Because understanding this today is different from understanding it when the impact is already in your wallet. The announcement came like a bombshell, a 100% tariff on Canadian products. No economist had predicted it. No company was prepared. It was an abrupt rupture, unprecedented in recent times, in the relationship between two of the world's largest trading partners. The market didn't react. It panicked. The detail that almost no one notices is that this tariff doesn't just target products. It affects entire production chains, from food to automotive parts. American companies that depend on Canadian inputs have been left with no room for maneuver. And the question that has begun to circulate silently in meeting rooms is this the beginning of something bigger? The impact was immediate on financial markets. In less than 8 hours, the Canadian dollar plummeted 6%. The Toronto Stock Exchange went into freefall. In the United States, major retailers saw their shares evaporate billions of dollars in market value. This seems purely financial, but it's not. This is geopolitics. Trump justified his decision as a measure of national economic defense, but the lack of communication with historical allies caught even members of his own government by surprise. The move was unilateral, strategic, and calculated. This is where everything begins to change. The tariff wasn't retaliation. It was a deliberate rupture. Unlike previous trade wars, where there were negotiations, threats, and retreats, this time there was no room for conversation. 100% is a blockade, not a tariff. The message is clear. Trump wants to rewrite the rules of international trade. The question lingering among analysts is, why now? Why against Canada? The country is, historically, the most predictable and cooperative partner of the U.S. Precisely for this reason, the impact was greater. It's the equivalent of attacking the most reliable link in the chain. Trust was broken, and so was trade. Meanwhile, companies across all sectors are racing against time to understand the true scope of the measure. Production lines have already been halted. Bilateral contracts have been frozen. And each day without a response exacerbates the perception of instability. This seems small, but it's not. It's the beginning of what could become a domino effect. Some sources claim the decision was motivated by an internal report showing excessive dependence on strategic inputs from Canada. If this is true, what comes next could be even more aggressive, targeting Mexico, the European Union, and even Asian partners. The tariff was just the beginning. The mainstream media tries to fit this decision into the logic of elections, but this is much bigger than votes. We are witnessing the emergence of a new economic doctrine where extreme tariffs become political tools of deterrence. What seems like madness is strategy. And if Canada was the first target, we need to understand why was he chosen? Because that's where the real chess game of this crisis begins. That's what we'll explore in the next topic. Of all the countries that could have been targeted by a 100% tariff, few imagined it would be Canada, not because of its strength, but because of its proximity. Canada is the United States' largest trading partner and perhaps the most reliable. Precisely for that reason, it was chosen. The relationship between the two countries involves more than $2 trillion a year. There are over $750 billion in cross-exports, integrated factories, connected logistics systems, and thousands of binational companies. Tearing down this bridge is like blowing up the train tracks. But behind this apparent madness lies a cold calculation. Trade between the two countries isn't just about soybeans and aluminum. It includes technological components, automotive parts, energy derivatives, semiconductors, and processed foods. Now, the United States doesn't buy from Canada out of kindness. It buys because it depends on it. And that's the weakness Trump decided to exploit. According to sources within the Department of Commerce itself, the objective would be to test the resilience of the American economy under a new paradigm, that of forced self-sufficiency. This may seem like mere economic theory, but this is where things start to spiral out of control. Aggressive protectionism can isolate, but it also suffocates. The geopolitics behind this decision are more complex than they seem. Canada has been making progress on parallel agreements with China and the European Union. Some say Washington saw this as a silent threat to American hegemony in the hemisphere, and Trump, as always, acted preemptively, explosively. Another point ignored by most. Canadian domestic policy has been moving away from American interests. Trudeau has made recent statements about energy independence, state-issued cryptocurrencies, and greater trade alignment with BRICS Plus. Small statements, but ones that are raising alarms in Washington. The 100% tariff in this context is not merely economic. It's a show of authority, a way of demonstrating who's in charge in North America. And if Canada submits, the others will get the message. This has happened before, in previous cycles of trade wars, and it always ends the same way. The problem is that Canada is not a peripheral country. It has oil, gas, technology, and legal stability. If it retaliates, it could contaminate the entire chain of trade agreements in North America, including the largest one, the $2.4 trillion agreement that is now in the firing line. Understanding why Canada was the first is understanding who might be next. Mexico, South Korea, Japan, all with fragile bilateral agreements and interdependent economies. The shot in Ottawa could reverberate around the world. But the epicenter of the crisis is still here. And it is at this point that we need to reveal what is truly at stake. A $1 trillion agreement that underpins the region's trade. The agreement on the verge of collapse is the USMCA, the United States-Mexico-Canada Agreement. It replaced the old NAFTA and represents one of the largest trade agreements on the planet. In total, it moves more than $2.4 trillion a year. This is the backbone of the American economy. Just to give you an idea of the scale, more than 70% of Canadian exports go to the United States. And about 30% of jobs in the American industrial sector depend directly or indirectly on imports from Canada and Mexico. This seems technical, but it's structural. To tamper with this agreement is to tamper with the entire foundation of the American economy. The 100% tariff breaks the core clauses of the USMCA. The principle of free movement of goods with reduced tariffs is at the heart of the agreement. By imposing a total barrier, Trump destroys contractual predictability. And without predictability, investment disappears. Companies that signed contracts based on this treaty now face legal uncertainty, billions in losses, and disrupted supply chains. Large automotive industries, for example, manufacture engines in Mexico, assemble parts in Canada, and finish the process in the United States. This cycle was paralyzed overnight. And what almost no one realizes is that banks are also part of this cycle. Financial institutions finance thousands of projects based on the stability of the USMCA. Now, with the technical collapse of the agreement, the risk spreads to the financial system. A broken trade generates contaminated credit. And that is the beginning of the ripple effect. The $2.4 trillion figure isn't just a statistic. It's a portrait of how integrated and interdependent the North American economy has become, and therefore how vulnerable it is to extreme measures like this. That's why large funds have already started reallocating positions. And you haven't seen it in the newspapers yet. Trump may claim he is protecting American jobs, but the irony is that many of those jobs only exist because of the efficiency generated by regional integration. By trying to strengthen local industry, he may be triggering its silent destruction. This is the tipping point. The collapse of the USMCA won't be announced with fireworks. It will happen gradually, with factories closing, contracts being broken, and prices skyrocketing. International trade, previously invisible to the average consumer, begins to take its toll. That's why this isn't just an institutional problem. It's a problem that has already begun to affect the economic reality of millions of people. And what happens when this machine jams? That's what we're going to see now. The domino effect on the real economy. It all starts with a tariff. But within a few weeks, the impact spreads like a silent virus. Transportation companies halt operations. Factories reduce shifts. Shelves take longer to restock. And the consumer begins to notice the price of what they buy every week keeps rising. The sectors most affected are those that depend on integrated logistics. The automotive industry is the first to feel the impact. Next come electronics, processed foods, and industrial machinery. The chain is interconnected. And when one piece breaks, all the others try to survive, usually by laying off workers. Companies that were once stable now have to recalculate costs, renegotiate contracts, and, in many cases, cut staff. Uncertainty becomes the new normal. Investments stall, new factories are postponed, and credit begins to dry up. Fear of failure becomes greater than the desire to grow. Stock markets react before everyone else. Institutional investors withdraw capital from sectors considered exposed to Canada. And in a matter of days, billions evaporate from major players in the American economy. This seems distant until it hits retirement funds, personal investments, and pensions. And here's a detail that almost no one notices. A large portion of Canadian companies have cross-ownership with American companies. In other words, when Canada suffers, Wall Street feels it. The collapse of trade doesn't respect borders. It severs the invisible connections that sustain stability. Meanwhile, the American consumer is beginning to realize that something has changed. That juice that used to cost $2 now costs $3.50. Meat has gone up 20% in some regions. Milk, coffee, appliances, everything is starting to go up. And it doesn't seem like there's any going back. This pressure on prices is already being called tariff inflation. A nice name for a very ugly problem, and the longer this trade war lasts, the harder it will be to reverse its effects. Because the damage isn't just in prices, it's in confidence. Entrepreneurs are starting to revise their plans, stores are stopping hiring, franchises are freezing expansion, and the impact is accumulating like tectonic plates before an earthquake. Analysts are already talking about a technical recession in the next 2 quarters, but the problem isn't the technical term. It's what comes with it. Unemployment, stagnation, hardship. The domino effect is underway, and the markets know it. Institutional investors are already rotating capital into defensive sectors, fleeing assets most exposed to international trade. Capital flight always begins like this: silent, strategic, calculated. But while the big players are shifting positions, the question the public is asking is more direct. Who's profiting from all this? And who's going to foot the bill in the end? Every crisis has its losers and its winners. The collapse of trade between the United States and Canada is already beginning to reveal who is being run over and who is repositioning themselves to profit from the chaos. The first victim is clear: the automotive sector. Car manufacturers that rely on Canadian parts are being forced to cut production, renegotiate contracts, and lay off workers en masse. Every car stopped on an assembly line represents thousands of dollars burning through every minute. This isn't adjustment, it's operational collapse. The second sector affected is industrial technology. A large portion of the sensors, electronic components, and materials used in American factories come from Canada. With inventories stuck at the borders, companies that were operating on tight margins are now operating at a loss. Agriculture is also suffering. The 100% tariff has increased the cost of fertilizers, seeds, and equipment. Farmers, already struggling with unstable prices, now face input inflation that could ruin their next harvest. And that all comes back to their plate. This is where it all starts to hurt people's wallets. But while these sectors are sinking, some are in a position to attack. Domestic manufacturers that competed with Canadian products now have room to raise prices without losing market share. Protectionism creates scarcity, and scarcity creates profit margins. It's the paradox of the crisis. Sectors such as mining, steel, aluminum, and local timber are being boosted by domestic incentives and reduced Canadian competition. This seems like a victory, but it's temporary. In the long term, these same sectors could suffer retaliation if Canada reacts with its own tariffs. Companies operating outside the Canada-US axis are also beginning to gain traction. Asian and Latin American exporters see an opportunity to fill the void left by Canada, and large funds are already moving to finance this silent transition. Another group that stands to gain are financial speculators. Hedge funds that bet against Canadian assets are reaping profits. They saw the signs before most. They knew a trade war was brewing, and now they are capitalizing on the chaos. But the big question is, who pays this bill? The answer is uncomfortable. You, the average consumer, the small investor, the local entrepreneur. Inflation affects your purchases, uncertainty affects your investments, and instability affects your ability to plan for the future. And when pockets start to bleed, perceptions change, the population feels the weight of political decisions. And they begin to ask, how will this fee directly affect my life, my cost of living, and my money? Most people only realize the magnitude of a crisis when it shows up on their bank statement or in their shopping cart. And this one has already begun. The 100% tariff imposed by Trump is not a diplomatic issue. It's a decision that directly affects your wallet. Within days, imported goods from Canada have already started to increase in price. Cheeses, meats, paper, furniture, appliances, tools. Everything that previously passed through borders easily is now stuck in customs lines and doubling in price. But the detail that almost no one notices, it's not just imported products that are going up. Domestic products are also skyrocketing, precisely because they now have less competition. This gives local producers room to raise prices. And guess who pays for it? The effect starts subtly. A 5% increase here, 8% there, but it spreads quickly. Coffee, milk, electricity, gas, and when you add it all up at the end of the month, income doesn't keep up. Salaries remain stagnant while the cost of living rises silently. And the dollar? The dollar is exploding. Investors fleeing risk are rushing to dollar-denominated assets, and ironically, this is strengthening the currency, but weakening exports. American products are becoming too expensive abroad, and this affects jobs, especially in industry. Another cycle of pressure. Short-term investments are starting to lose momentum. Equity funds, portfolios tied to the external sector, and even the urban real estate market are feeling the impact. Those who invest without understanding the current situation risk losing what they've built up over years in just a few weeks. Even worse is the psychological impact. When people start to see prices rising, income stagnating, and investments stalling, they reduce consumption. They postpone purchases. They cancel trips. They cut everything that isn't essential. And this creates the second side effect: economic contraction. This is not theory, it's the natural cycle of crisis. First, the commercial disruption, then the domino effect on businesses, and finally, the direct impact on the population. When everyone stops spending, the economy goes into survival mode. This is when fear becomes reality, and that's why tensions are rising. Analysts are already talking about stagflation, a stagnant economy with persistent inflation, the worst of both worlds, and the most dangerous because the population feels it is losing control and starts looking for someone to blame. At this point, the big question that remains is Trump going to escalate this trade war even further? Or was this just an initial pressure tactic? This is the most dangerous moment in a trade war, when it hasn't yet shown its full extent of the damage, but can no longer be ignored. The playing field has shifted, and now every move has amplified consequences. Trump has already signaled that new tariffs could be applied to other countries that are exploiting American good faith. This includes Mexico, some members of the European Union, and even South Korea. If this happens, the collapse of trade could cease to be regional and become global. Canada, for its part, has already recalled its ambassador, threatened retaliation, and is in negotiations with China to redirect some of its production. This change of course, if realized, could alter decades of commercial dependence, and the United States may find itself isolated by choice. At the same time, Mexico is watching everything closely. More than 80% of Mexican exports go to the U.S. If the pattern repeats itself, the next tariff could hit the Mexican economy, generating a logistical collapse on the southern border and a new cycle of instability. The European Union has already signaled concern about unilateral measures by the United States. Tension is growing behind the scenes in diplomatic circles, but it hasn't yet made the headlines. The detail that almost no one sees is that global patience with American leadership is running out. The markets haven't yet entered panic mode, but they're no longer confident either. Speculative capital is migrating to gold, silver, and a strong dollar. Productive assets are being liquidated, and the question behind the scenes is the same. Will this escalate? If the trade war intensifies, the world could enter a cycle of geopolitical realignment. Countries will seek new blocs, new agreements, new centers of influence, and the global economy may begin to reorganize itself without the United States at the center. This has happened before. History shows that prolonged trade wars never end well. They begin with protectionism and end with collapse. First, they affect the numbers, then confidence, then institutions, and finally the people, always the people. But there's one variable that no one can predict: the popular reaction. Public opinion, pressured by the cost of living and uncertainty, could force a strategic retreat, or it could double down if the narrative is well constructed. Everything will depend on the interpretation at any given moment. And now, the question remains, a question that troubles even the most optimistic: was this tariff the culmination of the strategy, or the first step towards a new global collapse? History has shown more than once the same pattern. A power grows, forms alliances, becomes overburdened, clashes with its own partners, and implodes from within. What we are seeing now is nothing new. It's just the next cycle, starting again. The 100% tariff against Canada is not just an economic measure. It's a sign, a milestone, a warning. And the question is no longer there will be consequences, but when will they directly affect you? The collapse of trade doesn't begin in the headlines. It begins with the silent breaking of agreements that no one thought would be broken. And those who understand this now have an advantage that few others have. Now tell me, are you just going to watch this story repeat itself? Or are you going to take a better stand? If this video made you think differently, subscribe now, turn on notifications, and leave a like. In the next video, you'll understand how the new American strategy could trigger an unprecedented global realignment, and which assets could become a safe haven during this transition. Because one thing is certain: those who see first act better.